In 2011, savings and credit cooperative societies lent more than 140 billion shillings to their members. But not all who applied for loans at their SACCOs got them.
Looking at the loan backlog went well over 30 to 40 billion. Now that means that for a SACCO, there are a number of people who applied but never got the loans because there was no liquidity available within the SACCO.
The cost of funding can now be singled out as the biggest hindrance to growth of the SACCO industry in Kenya, overshadowing governance concerns and tax issues.
Now there is a key issue of the lender of the last resort. Where do SACCOs borrow when they are stuck with the liquidity challenges? We are aware that the banking sector would borrow from the central bank, and they would also have overnight lending between themselves. Now, when we established the SACCO Regulatory Authority, the rules and the law, I think we did not think about where SACCOs will borrow from when they run out of liquidity.
On its part, the Kenya Union of Savings and Credit Cooperatives, through the Central Finance Fund, is attempting to create a conducive environment for SACCOs to operate by being their SACCO, hence seeking to multiply the amount of funds that SACCOs deposit with them.
So far, as we talk today, by end of the last financial period, the Central Finance Fund had a total of 4 billion. Our intention is to increase this fund to about 10 billion by end of 2013.
The Central Finance Fund is currently used by 1,700 SACCOs. The official spoke during the announcement of a Memorandum of Understanding between Cusco and Alpex Consulting Africa Limited on the Summit for African SACCOs and Cooperatives, set to be held on the 11th and 12th of October.
We have 1,500 delegates who have registered so far, including speakers and exhibitors from around the world.
The summit will discuss, among other things, sources for alternative funding for SACCOs, governance concerns, and taxation issues facing SACCOs. Alex Mwangi, NTV Business.